Spokane industrial vacancy held below the national rate in Q2, but negative net absorption signaled that the market's momentum has suddenly just, well, it's stalled out completely.
Yeah, it's essentially playing a massive game of musical chairs, right?
Yeah.
And the music just stopped.
Welcome to this deep dive, everyone. Today we are tearing into the Q2 2026 Spokane industrial market.
And just to set our baseline here, all the figures we're citing today are pulled directly from the Q2 2026 market report.
Exactly. And in under 20 minutes, we're going to give you everything you need to know about where this market is actually heading.
Which is critical if you're trying to navigate this transition period.
Totally. Oh, and if you want a custom market breakdown, maybe for your specific portfolio, you can reach out to Eric Peterson at ACT AV8 Real Estate, that is Activate Real Estate. His number is 509-903-9077.
Highly recommend giving him a call if you're modeling out a new deal right now.
Yeah, for sure. Okay, so let's unpack this. We need to set the stage before we really get into the weeds. Can you just give us the rapid-fire rundown of the Q2 headlines?
Yeah, absolutely. Think of this as your quarter in a minute. We've got four major forces colliding right now.
Yeah.
First off, demand is basically stalled out. Our trailing 12-month net absorption is negative 30,600 square feet.
Wow, negative.
Right, negative.
Yeah.
But on the flip side, the supply pipeline is extremely disciplined or, constrained, depending on how you look at it. There's only 402,000 square feet currently under construction.
And most of that is spoken for, right?
Exactly. It's 78.6% pre-leased. So the threat of new speculative supply just flooding the zone is practically zero.
Okay, that's a relief for landlords. What about rents?
Well, pricing is definitely showing the strain. Asking rents are averaging $9.60 per square foot, but that rate of rent growth has been slashed in half, dropping down to 1.3%.
Ouch. And the capital markets, I assume they aren't helping.
Not at all. They're essentially frozen. The Fed officially paused, meaning zero rate cuts in the first half of 2026.
Which guarantees debt costs stay elevated.
Yep. So if you remember just one thing from this deep dive, it's that the Spokane industrial market is fundamentally healthy, but it's aggressively transitioning out of its post-pandemic expansion phase.
All right, moving into a period of digestion and very selective capital deployment.
Precisely.
I want to challenge that fundamentally healthy label right out of the gate, though, because we have a massive macro disconnect happening here.
Okay, how so?
Well, you look at the headline data, and Spokane's 6.1% vacancy rate looks pretty solid. I mean, 4 quarters ago, it was 5.9%, so we aren't talking about some catastrophic spike.
Right.
And if you compare it to the elevated U.S. national industrial vacancy rate, which is sitting up at 7.5%, I mean, Spokane looks like a fortress.
And honestly, if you're a landlord who locked in a strong tenant on a long-term lease back in 2022, it probably still feels like a fortress.
Sure. But if you are trying to lease up vacant space right now, the reality is entirely different. It's less like a car gently slowing down on the highway and more like, I don't know, like a snake trying to digest a massive meal.
That is the perfect way to visualize it. Because the market swallowed an unbelievable amount of inventory over the last few years.
And now it literally has to just sit still and process that supply.
Exactly. What's fascinating here is the sheer scale of the math behind that digestion. If you look at the past 5 years, supply simply outran demand. Developers delivered 5.1 million square feet of space.
Okay, 5.1 million, that's huge.
But in that same window, only 3.2 million square feet was actually absorbed by tenants.
Wait, so there's almost a 2 million square foot gap. Developers aren't stupid. They don't just build 2 million extra square feet for fun. What was the underwriting error there?
Well, it wasn't really an error per se. It was a supply chain hangover.
From the 2021 and 2022 boom.
Exactly. Back then, demand felt infinite, and capital was virtually free. Developers scrambled to permit and build, but because of, material shortages and labor bottlenecks, it took years to actually get those buildings out of the ground.
Ah, I see. So by the time that 5.1 million square feet finally delivered,
The macro environment had completely flipped. The aggressive expansion tenants had already fulfilled their footprint needs, and the debt used to build those properties had suddenly doubled in cost.
right. You can only outrun your demand curve for so long before that gap catches up with you.
And we are seeing exactly who is bearing the brunt of that reality today. Because if you look at local employment growth, it's slightly negative, down to about 0.5% year over year.
Which is concerning.
But more concerning is the manufacturing sector specifically. That is contracting by about 2% year over year.
Wait, a 2% contraction? If you're a landlord holding older commodity product, what does that actually mean for your bottom line?
It means your primary tenant pool is shrinking. If manufacturing output slows down, businesses don't just stop expanding, they actively consolidate.
Oh, like taking 3 scattered warehouses and combining them into one efficient center.
Precisely. So landlords with older, disjointed assets are suddenly looking around, realizing they have to compete viciously for a shrinking pool of tenants.
They're fighting over a smaller pie,
Right.
which explains why rent growth got sliced in half.
Exactly.
But, paying a premium for specific types of space hasn't disappeared, which brings up this glaring contradiction in the report.
The flight to quality.
Right. If net absorption is negative and momentum is stalled, why on earth is a specific segment like small bay flex space commanding such a massive premium right now? Because the data there is just wild.
It completely defies the broader market gravity, absolutely. To put a specific number on it, look at the Baker Construction Flex units.
Okay.
Danes Capital recently leased those units at an astonishing $1.35 per square foot per month on a triple net basis.
Let me just run that math real quick. So that translates to roughly $16.20 per square foot per year. Now remind us what the market average is.
The average asking rent is just $9.59 per square foot.
So they're paying nearly double the market average in a stalled market. Why does a business cheerfully sign a lease at $16 a foot when they could theoretically find space for under 10?
Because that $10 space might actually cost them more money in the long run.
Wait, really? How does that work?
Well, this is the local expression of that massive national trend, the flight to quality. Tenants today aren't just looking for 4 walls and a roof to store pallets. They want operational efficiency.
So they need specific specs.
Exactly. They specifically want 2022 to 2025 vintage buildings. They need massive power capacity for automation, dog-high loading to turn trucks faster, and they absolutely require large truck courts to handle modern logistics fleets.
Ah, so the real estate is no longer just a static storage cost. It's an active component of their supply chain.
Right. If a modern building allows them to process 30% more inventory with the exact same headcount, well, paying a 60% premium on rent is entirely justified by the operational savings.
That makes a ton of sense.
You see this perfectly illustrated in the builder's supply lease. They took 36,600 square feet out in the West Plains submarket, and it exactly matches this profile of modern, highly functional space.
So demand isn't dead. It's just laser-focused on shiny, new, highly capable product.
Yep. And the older, functionally obsolete spaces are the ones dragging the total absorption numbers down.
And this isn't just an isolated phenomenon either. The report notes how Street Smart Idaho recently cited Spokane leasing activity as a leading indicator for what is going to happen next in Boise.
Which proves that the inland Northwest markets are mirroring these national bifurcation trends. The absolute best assets win big, and the rest struggle. It's just playing out on a slightly smaller regional scale.
But, building that high-utility modern flex space requires capital, and paying a $16 premium isn't just a tenant preference. It's a mathematical side effect of what it costs to actually construct that space today.
Which brings us straight to the Fed's doorstep.
Yes. We keep hearing this mantra, higher for longer. Here's where it gets really interesting. How is the macroeconomic rate environment actively throttling local builders right now?
Well, it's the defining constraint of the entire commercial real estate sector. If we look at the Federal Reserve data pulled live from FERDAD as of early July 2026, the reality is incredibly stark.
Lay it on us.
The Fed paused at a target range of 3.50% to 3.75%. But more importantly, they executed 0 rate cuts in the first half of 2026.
Which completely blew up everyone's pro formas. I mean, if you underwrote a development deal in 2024, you were almost certainly baking in the assumption that the Fed would have dropped rates by 100 or 150 basis points by mid-2026.
Oh, absolutely. The relief that the entire industry penciled in simply hasn't arrived, and the bond market is reflecting that pain. The 10-year Treasury drifted up about 30 basis points to 4.49%.
Wow.
And the 2-year Treasury climbed even more aggressively, up about 60 basis points to 4.14%.
Break down how those specific basis point moves actually kill a deal in Spokane today. What happens when a local developer walks into a bank trying to get a construction loan right now?
The conversation is completely different than it was 3 years ago. First, the actual cost of the money is painful. SOFR-based floating debt is sitting near 3.63%.
Okay.
But it's not just the interest rate, right? It's the structural constraints lenders are placing on the capital. Banks are forcing exceptionally strict DSCR limits.
Debt service coverage ratio.
Exactly. They want to see significantly more projected cash flow covering the loan payments to buffer against risk.
Because they know rent growth is slowing, so they won't let you underwrite aggressive future revenue to justify the loan today.
Right. And on top of that, they're demanding very conservative loan-to-value ratios. The days of 80% leverage are long gone.
So what are we looking at now?
You might be looking at 55% or 60% LTV, which means the developer has to bring massive amounts of expensive equity to the table just to break ground. The capital tap hasn't been turned completely off, but the water pressure is exceptionally low.
You know, earlier you said developers are being disciplined with only 400,000 square feet under construction. But isn't that just a polite way of saying they literally cannot secure the loans to build anything else? It's not restraint, it's a capital drought.
That is a very, very fair pushback. A significant portion of that discipline is absolutely lender enforced. If the math doesn't work, the dirt doesn't move.
Which leads to the obvious question on the investment side. If the 10-year Treasury is creeping up, the Fed is frozen, and lenders are demanding massive equity checks, shouldn't the local investment market be completely dead? Who is actually buying industrial real estate in Spokane right now?
It's a fantastic question, and the answer requires looking past the headline numbers to see the actual negotiations taking place.
Okay, let's hear it.
So CoStar puts the market cap rate for Spokane Industrial, at 8.1%. But if you look at the actual recent trades that are managing to cross the finish line, they're happening in the high 6% to low 7% range.
Interesting.
And crucially, they're typically closing about 10% below the initial asking prices.
Oh, wow. So we have a massive reality check happening. The bid-ask spread is finally compressing because sellers are realizing that buyers simply cannot afford to pay 2022 prices with 2026 interest rates.
Exactly. Sellers are having to meet buyers where the debt costs dictate. I mean, if a buyer's debt costs 6.5%, they cannot buy a building at a 5.5% cap rate.
Right, because that creates negative leverage. The property is literally draining cash on day one.
Yes, they need that 7% cap rate just to break even on the financing.
And who are these buyers forcing these 10% discounts?
Well, we've seen a major demographic shift in the capital pool. National and out-of-market investors now represent nearly 60% of the purchasing volume.
Wow, so they've actually surpassed local buyers?
By dollar volume, yes. Local buyers account for about 40% of the total dollar volume now.
Unpack that mechanism for us. Why is national capital suddenly so interested in crossing the mountains to buy in the inland Northwest when lending conditions are this tough?
Because of the structural yield discount. Let's look at a major coastal market, like Seattle. The industrial space there is incredibly tight and highly priced. Cap rates might still be hovering in the low 5% range.
Right.
So if national money tries to buy in Seattle with 6.5% debt, the math completely breaks down. But if they look at Spokane, they can acquire highly functional industrial assets at a 7% or 7.5% cap rate.
So even with elevated debt costs, they can achieve positive leverage.
Exactly. They are chasing that 200 basis point spread because it's literally the only way their investment models generate a return right now.
That perfectly explains the dollar volume. But what about the actual frequency of deals? If national players are throwing the big money around, are local investors just sitting on the sidelines?
Not at all. And we have to clearly distinguish between dollar volume and transaction count here. While national money drives the massive portfolio volumes, private, local capital still absolutely dominates the count of transactions. Over 80% of actual deals done are local.
Over 80%. But how are local buyers getting around those brutal DSCR requirements and low leverage limits from the banks you just described?
Because they are playing a different game entirely. They are mostly buying in that small base segment we discussed earlier, and they are doing it either with all cash bypassing the debt markets completely, or they are utilizing SBA financing.
Ah, right, SBA loans.
Yeah, they offer higher leverage for owner users and are inherently less rate sensitive than traditional commercial debt, which heavily insulates that specific segment of the market from the broader macro headwinds.
Let's make this highly tangible. We promised to look at trailing 12-month data to provide real-world proof points. Give us a sense of what a major institutional deal looks like when national capital comes hunting for that yield spread.
Okay, a prime example from the trailing 12 months happened in July 2025. SMBC Nikko Securities purchased a 106,000 square foot manufacturing facility out in Spokane Valley.
From who?
They bought it from Whitaker Management Group, LLC, for $11 million.
Okay, if we run the math on that, it breaks down to about $103 per square foot. That is a massive institutional scale footprint.
Yeah.
Now, contrast that with the local owner-user dynamic you were just talking about. What does that look like in practice?
A perfect contrast is the R&R heating and air conditioning deal.
Got
They are an owner user, meaning they aren't buying the building to lease it out for yield. They are buying it to operate their own underlying business.
Right.
They purchased a 22,000 square foot service building that they were actually already occupying. They bought it from a private investor for $3.6 million.
And doing the math there, that's roughly $162 per square foot. That is significantly higher than the $103 per square foot the institutional buyer paid.
Exactly. And this highlights a really fascinating dynamic hidden in the market data. While owner users make up less than 1 in 10 transactions by actual count, they account for nearly a fifth of total sales volume.
Because they value the real estate through a completely different lens.
Right. The institutional buyer is plugging cap rates and SOFR floating debt into a spreadsheet to calculate internal rates of return.
While the owner user is looking at the building and saying, if I don't secure this facility, my HVAC business can't dispatch trucks tomorrow.
Precisely. They are buying operational security, which allows them to justify a much higher price per square foot. They aren't trying to outsmart the bond market. They're trying to protect their business operations from future rent spikes.
That makes total sense. So we really need to pull all of these threads together. We've dissected the stalled demand and the digestion phase of the supply cycle. We've looked at the intense flight to quality, and we've seen how the frozen Fed has forced a 10% discount on asset pricing just to make the debt math work.
It's been a massive shift.
It really has. So as we look toward Q3 2026 and the balance of the year, what exactly does the data suggest is coming next?
Well, the forecasting model strongly suggests we haven't quite scraped the bottom yet. CoStar project that vacancy will slowly tick up to 6.7% by the end of 2026.
Okay.
Furthermore, annual rent growth is expected to decelerate even further, dropping to just 0.6%. To put that in perspective, the nationwide projection for rent growth is 1.2%.
So Spokane is cooling slightly faster than the national average, likely due to that 5.1 million square feet of supply we are still actively digesting.
Yeah, that supply overhang is real.
If you are holding a portfolio today, what are the specific red flashing lights you need to be watching over the next 2 quarters?
There are 2 competing macroeconomic forces you really must monitor closely. First, any further slowdown in goods-producing employment will act as an anchor on the market. If manufacturing keeps contracting past that 2% mark, demand for large-scale space will stay incredibly soft.
But on the flip side,
We have steady population growth, currently running at a positive 0.3% year over year.
and a lot of that is driven by coastal in-migration, right? People moving out of Seattle or California, crossing the mountains, seeking a more sustainable cost of living.
Yes, and that steady demographic base provides a very solid structural floor for the market. Those new residents buy groceries, they order e-commerce packages, and they require local services.
Which all fuels local consumption and necessitates regional distribution networks. It functionally prevents the bottom from falling out of the industrial sector.
Exactly.
It's a massive tug of war between a slowing industrial manufacturing economy and a steadily growing consumer base, which brings us to the end of our analysis today.
And this raises a critical, longer-term question to leave you with as you look at your own strategies.
Let's hear it.
If population growth from higher-cost coastal metros continues to provide a dependable demand floor, but local goods-producing job growth remains completely flat or negative, will local consumption alone be enough to kickstart the next cycle of major industrial development in the inland Northwest? Or are we entering a multi-year holding pattern where we simply trade the existing modern inventory back and forth?
That is the multi-million-dollar question, and the answer will likely dictate who wins the next cycle. To dig deeper into these numbers, to run these cap rate scenarios, or to discuss what this specific transition period means for your own portfolio, reach out to Eric Peterson at ACT Aviate Real Estate, that is Activate Real Estate, 509-903-9077.
He's the guy you want in your corner for this market.
Absolutely. Thank you for joining us on this deep dive. Remember, in a market where momentum has stalled and the music has stopped, understanding the mechanics behind the data dictates the difference between a good deal and a great one. We'll catch you on the next deep dive.